Leading the Dow today was Walmart, while Pioneer Natural Resources was the biggest decliner. Over in the S&P, MGM Resorts International was the winner today. PPG Industries, big loser, down 10%, was the laggard. Mike, couldn't hold on to some early momentum, still fears of rising rates?
I think that's in the background. I don't think the action today would have changed anyone's mind, whether you thought, the market looked like it was oversold, ready to bounce, the big tech stocks had actually taken a pounding and they were coming back in the morning. Or if you thought that, in fact, the market's a little bit fragile here and the breadth has been poor. Both those things, I think, were coexisting today. Apple up 1.4%, starting in the afternoon, really kind of held the indexes together. So I think it was kind of a push, as they would say in Vegas.
Quite a big sort of dissection in terms of the sector performance.
Yeah.
Materials very much the laggard, energy towards the top. Market's trying to find its feet in terms of direction in that sense, and
a little bit. Although the materials was all about that PPG warning,
right.
So essentially you had a kind of a chemicals paint maker that just kind of fell apart after a warning, and it took a lot of other stuff with it. So I think that's why investors have a little bit of a raw nerve on anything that seems like we're past the peak in terms of cyclical stock earnings.
I mean, look at the industrial, second worst performing group, down 1.5%. Savita, what does the action today and in recent sessions tell you about where the market jitters lie?
Yeah, I think the market is digesting the idea that rates could actually move higher, and we haven't seen that environment for quite a while. So I actually think the market internals still look pretty healthy. I think it's more of a stock pickers market than a sector pickers market even. I mean, we wrote a note about this the other day where we pointed out that, within every sector, there are some companies that have taken advantage of low interest rates and locked in very long-dated fixed rate debt, whereas there are others that have much more floating rate risk. So I think that's one factor that we have to think about now that rates have done something besides just go down. I also think that this is a time to really focus on balance sheets. So leverage is starting to become more of a risk in an environment where interest rates and the cost of capital is increasing. The two sectors that I would watch out for are the higher growth kind of internet tech companies that are in communication services. That's a sector that we launched with an underweight a few weeks ago. And the idea there is that these are capital intensive companies. They need money to grow, and they're not going to do as well in an environment where the cost of capital is increasing. The other area which has done perversely well over the last couple of days, despite this move higher in rates, is utilities. And I still think when you look at utilities, equity income investors are going to move back to bonds in an environment where you're getting competitive yields, in your traditional asset class. So I think that those are the two areas of the market that are under potentially the most pressure today.
Well, one area that's been under pressure of late, of course, housing stocks getting crushed, taking a direct hit as interest rates continue to rise. Home building ETFs are trading in bear market territory, with the ITB down more than 20% this year. What's your view on that, Savita?
The home builders in particular, I think, are, kind of a mix. They're inexpensive. But I do think that, consumer plays, housing, retailers, the whole consumer discretionary sector looks a bit risky at these levels. Because, again, when you think about the equation that consumers are facing today, it's, spend and borrow versus save. And saving is becoming more attractive. So I think, it's pretty simple. As rates rise, your decision to spend and borrow versus save is skewed more towards saving. And I think that's going to hurt some of the housing areas as well as traditional retailers and discretionary items.